understand where he's finding value in the market. When we spoke to him last time, he was very clear that it was banks, few names in the consumer space, and everything else was expensive. But now we are looking at a very different kind of dynamics. When we spoke to you last, the backdrop was the following. FIs were selling, earnings had slowed down because of the base effect. Dollar was strong, rupee was weak, and there was a lot of confusion around tariff. When we're speaking to you today, markets have managed to climb the wall of worry. Where are we headed next now?
No, I think a lot of good things for India in particular have happened in the sense that the dollar has weakened, crude has fallen. I think RBI has become fairly dovish. So I actually don't expect earnings to be anything great over next 2-3 quarters. But I think the strength of the macro in terms of the currency, if you see our current account deficit, if you see our inflation, if you see our interest rate trajectory, and also the geopolitical narrative. So I think medium term, I do think that a lot of things that US is trying to do are good for India. It may obviously be a very rocky path to there, but if you think about it, um, what does US want? They want to reduce um, China's current account deficit, which could mean manufacturing moving out of China. They want lower energy prices. They want lower bond yields. They want, although they may not explicitly say this probably, but I think they want a weaker dollar. So all this is actually what India also wants. So I think the macro narrative is what will support the market. I think it's a fair thing to say that US will definitely slow down. The extent of that slowdown is very difficult to gauge. It could be right from a mild slowdown to a deep recession. No one can predict that. So it's not a market where you need to be very greedy. But I think the chances of macro narrative overpowering quarterly numbers is quite high.
Markets running slightly ahead of themselves, or they've really run ahead of themselves, and next 6-8 months either we could see price correction or time correction or both?
I don't think at overall headline index level we will make big returns. But I think it's all about being nimble and catching the themes that can potentially work in the medium term. I think there are fair amount of interesting themes which can work. Nothing is definite, but I think, for example, there is this tech platform segment. There is the shift of manufacturing from China segment. There is this beaten down financials segment. Personally, I think these kind of themes do look attractive from a risk reward perspective.
Manish, hi, morning. So just understanding, in the very near term, what are we staring at? Yes, for the year, also one has muted expectations, but a lot of factors at play. While there is everything that's working for us, but there is that big, overhang of US economy. And what if it heads in for a slowdown? And one is trying to work with that assumption too. So what sectorally do you think one should be overweight on, underweight on, and completely avoid right now?
Yeah, so as I said, I am not very positive on global growth or as a corollary, even on India growth from a 1 year perspective, in the sense that there is a range of probability outcome, but there is a decent probability that there'll be a severe slowdown globally. So I don't think you can have a very, very cyclical portfolio at this point of time. Just following up from what you said, I think the risk reward in buying anything related to US economy is not great. So if you think about business cycles in three parts, US, India, and rest of world, which is Europe and China, I think the expectations are least from Europe, China kind of stuff. And maybe there are some contrarian bets on that cycle, which is metals and global auto. which are worth owning purely because expectations are beaten down. India is the best macro, but Indian uh, domestic facing stocks tend to be expensive. Um, but there, maybe the theme of China plus one expanding from traditionally chemicals to a lot of new segments may work, I think. But yeah, anything to do with US economy is a bit risky, I would think.
Manish, good morning. This is Shrishti also joining in. So the advice coming in to stay away from the export-oriented companies and rather look for domestic plays. But what within the domestic counters, which sectors are you preferring right now?
No, what I meant was anything which is very cyclical and linked to US economy is probably risky. But exports, general global exports to Europe, China, I think the stocks are quite cheap. If you see, they've done nothing for 2, 3 years at least. And I think that part is worth a bet. Um, but I don't think you can be very aggressive because if US slows down more than we think, then even Europe, China can't do well. Even India will not do well as we think. So as I said, it's not probably a time to be very cyclical, but I would still say that any good manufacturing exporter from India, if the valuations look reasonable, I think they are worth a bet because we don't know. See, all we know is that it's a once in a generation supply chain shift that will happen. I think you can be fairly certain that China's current account will go down. Uh, and it will go down as a mix of exports coming down and imports going up. Um, but I think safe to say that China's share in manufacturing will go down. Now, who benefits, which category benefits, which country benefits, is not exactly clear at this point of time. Uh, but I think as a theme that is worth looking at. Domestic side, I guess it is a bit of a consensus view, but the only risk reward space that looks attractive is financials which are below book or one time book. Um, because India's macro is good, asset quality hopefully will not deteriorate unless US goes into a very, very deep recession. I think that risk remains, but at least you're getting paid to take that risk. I think auto capital goods generally look expensive to me. So yeah, I think on the domestic side, beaten down financials is, I think, the only really attractive cyclical sector.
Banks sub price to book. I can only think of PSU banks. वो भी दो तीन नाम ही है.
No, there are a lot of private banks, housing finance companies, which are 0.91, 1.1 type book. I think they're okay. I mean, I think they're decent risk reward. May not be super buy and hold stories, of course. But yeah, I think you can make 20 to 30% in a year, I think, if things go right.
My question perhaps may sound slightly repetitive, but I just want our viewers to understand where we stand. Earnings have been okay and macros have improved on the margin, but markets have been great, which means the price action surely has been more exciting than the change in the economy. So at this juncture, are markets pricing in a lot of good news, or this is something which markets will be able to digest and sustain?
Look, there is a feeling that markets are frothy, but that's probably because of mid and small cap performance over the last 3 years. I think objectively, if you see long-term data, the best correlation of market levels is not to GDP growth, but to inflation. So if you see the 10-year real return on Nifty 500 is about 6%, which is exactly where it should be theoretically, because if you see empirically, every um, market tends to converge at about 5 to 7% real return in equities when you see very long-term data. Obviously, this doesn't work on a 1 or 2 year kind of time frame. So I don't think this is a market to be excessively worried about. I think there is a bit of narrative about this being a bubble. I don't know, but the data doesn't seem to suggest if in 10 years the equity markets have returned about 6% real return, it's not typically a level at which you should worry too much about market level. Now, you could say large caps are cheaper and all that. Yes, from a 1 year perspective, that may work. But I think it's a market where if we focus on just themes and bottom of work, there is enough risk reward available.
Okay. Manish, I'd like to draw your attention to this whole FI aspect. Suddenly they are back. And FIs, when they come back, they tend to stay for long. Can we be reasonably sure that in the next few months, a quarter, maybe 2 quarter, liquidity will not be a problem? FIs are back, promoters are not selling, IPOs have dried up. So at least on the liquidity front, you can be more constructive.
Yeah, as I said, see, ultimately you're part of the globe, right? Now, if you have a country where your biggest import energy is structurally looking weak in terms of prices because of EVs and renewables, and if you have a country there, the biggest export, which is services, seem to be very resilient. So even when listed IT services companies have slowed down, if you see our net services export has held up remarkably well. So, I mean, if someone is looking at long-term asset allocation globally, it is difficult to believe that you can be negative on Indian rupee or Indian assets. That doesn't mean every 3 months we will see positive foreign flows. But if you take a 3-5 year view, I would think that foreign capital should come meaningfully into India. Maybe fixed income and FDI are more attractive because we tend to be expensive on listed equities. But I do think that we will not see any big outflows, in the sense that, yes, we saw outflows, but ultimately, if the market is attractive, I think foreign inflows will be healthy. And the near term, I think everything, or not everything, but a big factor is the dollar, right? So if the dollar index went from 110 to 99, I don't think it's very surprising to see foreign flows turning positive.
Manish Bhai, thank you very much for joining us. And by the way, Manish Bhai, I was talking to Vallabh Bhai yesterday about Vipassana, and I know you'd gone there. So just reminds me of good things which are happening.
Yeah. Yeah, that's interesting.
Okay. Nice to have you back on ET now. Thank you for joining us. Surendra Goyal, Managing